Welcome to Get Rich Education. I'm your host, Keith Weinhold. What does it take for you to qualify for a 1 to 4 unit income property loan today? We're discussing that and more with perhaps the most qualified person in the United States to discuss just that today on Get Rich Education.
Are you looking for a roadmap to financial freedom? If so, we have a solution for you. Norada Real Estate is offering a limited number of free strategy sessions to help you get out of the rat race. Learn how you can create wealth and build monthly passive income. To set up a time with one of our knowledgeable investment counselors, simply go to noradarealestate.com. That's NORADA realestate.com.
For an income property investor like you that needs an income property loan, go to Ridge Lending Group. And over the years, you've heard owner Caeli Ridge generously give her time to you right here on the show as a guest. Ridge provides investment property loans in almost every U.S. state, and you're going to find out how they've helped more Americans realize their dreams of financial freedom through real estate than any other mortgage lender in the entire nation when you get started at ridgelendinggroup.com. Get Rich Education is brought to you by Ridge Lending Group, Producers Wealth, Norada Real Estate, and Total Control Financial.
You're listening to the show that has created more passive income for people than nearly any show in the world. This is the powerful Get Rich Education.
Hey, welcome to GRE. From Paris, France to Paris, Texas, and across 188 nations worldwide, I'm Keith Weinhold, and this is Get Rich Education. You know something? The word debt is probably my favorite 4-letter word. As long as I can lock up long-term, low, fixed interest rate debt for 30 years, like I still can today, where the tenant pays down the loan for me, I want to tie up all of the properties that I practically can that way, especially when interest rates are certainly still near their lows, although they're off those lows. People paid mortgage interest rates of 10%, 12%, 15%, and even 18% over the last few decades, and that was on their primary residences. Well, today, you can still get an interest rate on rental property that you don't even intend to live in for under 6%. And I am still an active buyer today myself. In fact, interestingly, I was just looking at 2 different single-family income property deals that came across my desk. Each property had 2 different prices. One was a financed price, and then the other was a lower cash price. So the first property had a financed price of $147,900. Okay, $147,900 if you're financing it, if you want a loan. Or that same property had a cash price of $144,900. So a $3,000 savings for not getting a loan. Then this same provider had a second property where I looked at its details. It had a finance price of $123,900 and a cash price of $121,400. That's a $2,500 savings on this second one. So the provider has a lower price if you buy all cash because they can sell it faster. You don't have to go qualify for a loan. Now, if someone had a few $100,000 of free cash sitting around, they might be tempted to take the quick savings. That's a sale price savings of about 2% on each property. Well, paying cash is just typically an uneducated thing to do, as we've discussed before. Having a loan in place creates leverage. Leverage amplifies wealth. Buy and hold real estate investing is a long-term game. If you think real estate is going to be worth more, or more accurately, if you think real estate is going to take more dollars to buy that same real estate in 10 or 20 or 30 years, well, then you would want to own more property, not less. You can own 4 to 5 times more properties with loans on them than you could if you paid all cash. And of course, tenants and inflation both simultaneously, gradually pay down the principal for you. Now, if you could own $1 million worth of property paid off, well, then you could own $5 million worth of property with 80% loans on them. If real estate appreciates 5%, if you just had the smaller $1 million portfolio, that will give you a $50,000 appreciation gain over the next year. And if you had a $5 million portfolio because you had loans, that's going to give you a $250,000 gain just over the next year, just from the appreciation component alone, because you've got leverage. Remember, mechanically, if you pay a property off, what you have just done is you've converted your cash or your cash flow over to equity. Well, financial freedom is achieved by strategically behaving oppositely. That is, converting your equity to cash flow. Today, we're talking to the president and CEO of the mortgage loan company that's done more rental property loans than any other company in the United States. Now, you might remember that we also chatted here last year, but mortgage rules do change a lot, so they're really crucial to your wealth building. That's why we want to get an update. So now, if you're listening to this show in this episode in the year 2022 or 2025, well, mostly take today's episode merely as a point of historical context, okay? This show pertains to today's lending environment here in late 2018. I'm also going to ask our guest about how it's going with appraisals, because with all the loan applications that they see there at Ridge Lending Group, what percent of appraisals come in lower than the proposed purchase price? What percent come in right on? And what percent come in high? Let's welcome back today's guest. Today's guest is the president and CEO of Ridge Lending Group, and she has spent the last 20 plus years as a nationwide lender, loan officer, and a real estate investor herself, so she really understands what you need. Her firm specializes in income property loans, and they've worked with tens of thousands of investors and homeowners just like you all over the U.S. and outside the U.S., and if you've been listening here for any amount of time, you already know that she has helped more people realize their dreams of financial freedom through real estate than any other mortgage lender in all of the United States. So it's a real honor to welcome back onto Get Rich Education, donating her time to you once again. Here is Ridge Lending Group President and CEO, Caeli Ridge.
Keith, thank you for such a warm welcome. It's always my distinct pleasure to be here with you and your listeners. I'm very excited to share some content today.
It's so good to have you back. And just to reiterate, we are not talking about primary residence loans today. We're talking about lending guidelines in the 1 to 4 unit space for single-family homes, duplexes, triplexes, and fourplexes, non-owner occupied properties, income properties that you don't live in. So, Caeli, these guidelines are so dynamic, so just give us a review of what it takes to purchase these properties as far as down payment, FICO scores, DTI, reserves, and so on.
So you're right. It is a very different animal, the difference between owner-occupied and non-owner-occupied. And as a result, in talking about conventional guidelines, conventional or Fannie Mae, Freddie Mac, the rules are quite different. So usually what I'll do is I'll start by kind of quantifying for my clients that there are 10 of what we call golden tickets, Fannie Freddie loans, per qualified individual. Now, of these 10 loans, many may not know that there are 2 very distinct, we'll call them books, underwriting books, that we have to, as the lender, have to adhere to in qualifying the individual. The first book applies to the loan spots 1 through 6 of the 10, and then there is a second book of guidelines or criteria that we have to subscribe to qualify in the 7th, 8th, 9th, and 10th loan spot. So it changes. I think that we're pretty good about helping our clients navigate and educating them about some of those differences. But for your listeners today, I'll just kind of go over a quick abbreviated 101 lesson.
Please.
So for the down payment, let's talk about that first. So there's going to be a difference between single family residence and the 2 to 4 unit properties that they may be considering. There's also a difference between purchase versus refinance, but I think we're focusing on purchase, right? Down payment. Single family residence, they can expect, generally speaking, 20% down is what most people will put as their down payment. However, I should probably briefly mention that the rule allows for single-family residents all the way up to 85% leverage, where they're only putting 15% down. Now, as a sidebar, those loans will come with a slightly higher interest rate. You can expect maybe a quarter of a point increase, and they will also come with PMI. This is private mortgage insurance. Now, anybody that knows what that is will generally try to stay away from that. But on an investment property, if the capital that the individual has to work with might be limited, the PMI factor itself is rather low. Without getting into too many specifics, I would maybe recommend for the individual to look at the differences side by side, taking one example property and seeing what do the numbers look like at 20% down versus 15% down. They may be surprised that the cash flow doesn't change all that much, but they've stretched the dollar, optimized the dollar to its optimal place.
So on single-family income properties, 20% down, giving you 5-to-1 leverage, 15% down, giving you about 7-to-1 leverage. However, with that greater leverage come a higher interest rate and a PMI premium.
Yes, exactly. So moving on to the 2 to 4, it's a straight 25% down. There's not going to be any allowance or exception to that. So just keep in mind when you're looking at a duplex, triplex, fourplex, 25% down is the requirement in any one of the 10 loan spots.
And everything we've talked about so far is through loan spots 1 through 6, or is that through loan spots 1 through 10, just for those criteria that we discussed?
Thank you for clarifying. The only exception there will be the 85% leverage. That only applies, again, to single-family residents and in the loan spots 1 through 6. Everything else applies to 1 through 10.
Got it.
So that's the down payment criteria. Let's talk about credit score, because there is a difference in credit score requirement between the 1 through 6 and 7 through 10 loan spots. The loan score requirement, well, first of all, let me explain that most individuals have 3 different credit scores. They come from places that I call repositories. The individuals will know them as Equifax, TransUnion, and Experian probably. Now we, as the lender, are going to take the middle of those 3 credit scores to qualify. In loan spots 1 through 6, there's really no hard and fast rule for credit score requirement. It's kind of vague, actually. I can take a 650 credit score and get an investor approved for a loan if they have compensating factors. These would be things like a low debt-to-income ratio or strong assets. So the credit score in 1 through 6, not hard and fast. But when we move into the 7 through 10, remember that underwriting book, they raise the qualification bar a little bit. There is a hard and fast now. The minimum middle credit score required to qualify is 720 or better. So depending on where the individual starts, I would say there are different tricks, I guess calling them tricks, or different ways of optimizing credit and being prepared strategically to look at what the, let's say, long-term goals are for the year, if they're going to be purchasing multiple properties, knowing that the credit report itself, each one is valid for 120 days. And if we know that there's going to be a lot of mortgage debt that's going to be hitting in a relatively quick period of time, we know that we probably want to run a second credit report in advance of the expiration of the first one, whereby optimizing the higher credit score before it might take a hit to potentially put us below the 720 mark if we're inching into the 7 through 10 loan spots. That might have been a convoluted explanation, but we understand how to navigate the battleship in a creek. It's the visual I try to give my clients. So where qualifications are concerned, we really understand how to sequentially optimize all of that. So those are the credit score requirements. Let's talk about assets real quick. So for assets, sort of like the credit score, there are 2 very distinct differences in what's required to qualify. The down payment is pretty straightforward, 20, 25%, whatever it is. Those funds need to be in liquid form, and those funds need to be sourced and seasoned. Sourced and seasoned just means that they need to have originated with the individual, and seasoned means that they need to show 2 months or 60 days worth of those assets coming from the account or accounts that belong to them. Now, that's the down payment. Let's talk about the reserve requirement. The reserve requirement will change depending on how many finance properties the individual has. Now, although we've talked about two different underwriting books, 1 through 6, 7 through 10, the reserve is a little bit different. And the rules changed recently, probably in the last 6 months. So I might muddle through this a little bit. But currently, if you have loans or finance properties 1, 2, 3, or 4, the reserve requirement will be equal to 2% of the unpaid principal balance on investment properties only. The primary residence does not count.
Okay.
In loans spots 5 and 6, that 2% goes to 4% of the unpaid principal balance, and it's retro. Then when you get into the loan spots 7, 8, 9, and 10, it moves up a bit again to 6% of the unpaid principal balance. So as an example, what I like to give for my clients is to just kind of put that into perspective. What I like to do for my clients is I like to give them an easy example to follow, and we'll use kind of the worst case up to the 6%. And in this example, we are going to assume that the individual is on their way to purchasing their 10th investment property. The 9 finance properties behind that, one of which is their primary residence. So we have properties number 2 through 8. And for our example, we're going to assume that every one of those properties has a $100,000 unpaid principal balance.
Okay.
So we've got $800,000 of unpaid principal balance that we need to calculate the reserve requirement. So you would take 800,000 times 6%. There's $48,000 in reserves that we need to show to qualify for the 10th property purchase. Now, I failed to mention that the subject property in this scenario, which is number 10, that's the property that's under contract to be purchased, needs to show 6 months worth of PITI, right? Principal, interest, taxes, and insurance, HOA if it applies. Let's, for our example, say that property number 10, the PITI all in is $1,000. So there's $6,000 of reserves for our subject property. We just calculated $48,000 for all of the subsequent properties in loan spots 2 through 9, giving us a total in reserves needed of $54,000. Now, one of the things about the reserves is it does not have to be liquid. The funds that we can accept to satisfy the reserve requirement can be retirement accounts, 401k, whole life insurance policies, self-directed IRAs. All of those are admissible to satisfy that reserve requirement.
I'm really glad that you gave a concrete example there. So compared to the recent past, reserve requirements are more lenient. Funds may be illiquid, and we have this UPB, or this unpaid principal balance calculation, which just is easier to meet than the requirements were in the past. So that's good news.
Yeah, I agree. You know, it takes a minute for investors to kind of get the 2, 4, and 6%. But I guess what I would probably recommend, if anybody's trying to do this math on their own, just use the conservative 6% on the whole thing and see where you are, and you can work the problem backwards from there.
6% of the unpaid principal balance, that is on all of your current outstanding income properties.
Correct.
Caeli, I've had some questions lately, and I explained it recently on an episode, but I'd like to get your spin. Some people ask, can a bank call the mortgage note due in full, or can a Heloc be called due in full at will? What do you tell people when they ask you about that?
You know, a lot of times when this topic comes up, they're talking about the due or the demand on sale clause, right? And more often than not, they're speaking about this or asking about this as it relates to LLCs for asset protection. Assuming that that's the context in which we're speaking about this, let me start by saying I am not an attorney, obviously, and I'm not here to give anybody any legal advice. They'll want to continue to do their own due diligence, speak with professionals. But from my own personal experience, I have executed an instrument that's called a quit claim deed, QUIT, whereby transferring title ownership from my individual name into my single member LLC hundreds of times over the years. I have never had an issue with a due on sale clause. Likewise, I can share that over a 20-year plus career, tens of thousands of my investor clients, I've known of them doing this very thing. It's never come back to me where anybody has had any issue with the due on sale. Now, I could take some time and put this into perspective. It's sort of a more lengthy explanation. I'm happy to give it on a one-on-one basis. My 2 cents are any set of conventional loans that anybody signs contains this language that reads, the individual does not intend, intent may be the operative word here, but that they do not intend to change the title ownership, and that if they do, the lender can exercise this due or demand on sale clause. Now, let me preface by saying that that's a scary way of saying the individual would be forced to refinance that loan at their expense, right? They're not going to show up at your house with handcuffs or levy your bank accounts.
Right.
But the cost of a refinance is enough that we want to avoid it, obviously. So given that and some other sort of, like I said, perspective explanation, for me personally, the risk did not outweigh the reward that LLC provided in asset protection as a little extra insurance policy or anonymity. So I was comfortable with using the quitclaim and putting it into the LLC. Now let me finally wrap that up and close with the type of LLC. And this is important. If you decide, like many investors, to put your properties in an LLC, it's very important that that LLC itself be a single member LLC. The only exception to that rule would be a 50-50 with a spouse. As an example, let's say that you transferred the title ownership after closing into a multiple member LLC, and the other member was a business partner of sorts, and that individual is not on the loan. What you've done in that case is you've actually changed the asset's ownership, and that could present a problem. Again, the exception would be with a spouse. That shouldn't be a problem. But in doing so, remember that if your spouse wanted to qualify at some point for his or her own 10 golden tickets, being on title to that property or in that LLC will chew up one of those spots. So I always recommend to keep LLCs separate from each other until you've maximized as many of the conventional loans as you had hoped to do.
So that's the LLC and the due on sale clause. Caeli, outside of that, have you ever seen a bank call a mortgage note due in full on either a regular residential loan or a Heloc, as long as that borrower is performing?
Yeah, as long as the mortgage is being paid and it's current, no, I've never seen or heard of it.
And basically, there is not language inside that mortgage note contract, as long as the borrower is performing, that they can call the note due.
That is absolutely correct.
Well, last time you were here, we talked about maximum loan-to-value ratios on a cash-out refinance for both your primary residence and your rental. And generally, on your primary residence, you could do a cash-out refinance up to about 80% loan-to-value, and it was about 75% on a rental. Is that still about true today?
Yeah, that's exactly true. So the delayed refi we had at 70% loan-to-value. It's been a recent change, again, 6-8 months. It's 75% without any seasoning. Before, you had to wait 6 months before you could use 75% of the ARV after repair value, but now 6 months seasoning is no longer required. So 75% immediately after cash purchase is applicable.
Now, in most markets, we've seen a substantial equity run-up in the past 8 years or so. That might also lead one to want to perform a 1031 tax-deferred exchange as opposed to a cash-out refinance. Any particular thoughts one should prepare for with a 1031 exchange when it comes to the mortgage loans?
Yeah, there's a lot of moving parts when you're looking at an exchange, and especially depending on what kind of proceeds you're going to be getting back and how many replacement properties you're going to be looking at. A few of the big ones, obviously, 45 days to identify. So from the date of sale, you have a very strict 45 days to identify your replacement properties. If one or two fall out within that 45 days and the 45-day clock is up, you cannot add anything else in. I think a good rule of thumb is to potentially select one or two more than you might actually close on, just to make sure that there's no issue there and that you've got all of your proceeds being used.
Yeah.
You're not taxed on a portion. Yep. Beyond the 45 days identification, you've got 6 months to close, hard and fast 6 months. This is going to sound funny, but literally, if you miss that 6 month window to close by a day, Literally, you need an act of Congress to reverse the IRS 1031 exchange policy.
And they are calendar days, including every Sunday and every holiday. It really is a generous thing that the IRS gives you with the 1031 tax-deferred exchange, but there really aren't any exceptions to that, practically speaking. You're listening to Get Rich Education. Our guest is Ridge Lending Group President and CEO Caeli Ridge. More when we come back. I'm your host, Keith Weinhold. Finally, Total Control Financial gives you checkbook control of your 401k and IRA money to invest in real estate. It's time to get your retirement money into your own checking account, but you've got to avoid the little-known tax that you'll pay with any self-directed IRA. Instead, it's time for the QRP. Learn more and get a copy of the QRP book by text messaging the letters QRP to 72000. That's text QRP to 72,000. MC Laubscher is the host of the top-rated business and investing podcast, Cash Flow Ninja, and also the president of Producers Wealth. Producers Wealth assists people in creating, protecting, and perpetually multiplying wealth in any economy through creating processes that help them increase their production, provide them with liquidity, passive income generators, and opportunities for enormous growth. Learn more about their time-tested and proven systems at yourownbankingsystem.com.
Hey everybody, this is Matt Bowles from Maverick Investor Group. You're listening to Get Rich Education with Keith Weinhold, and don't quit your daydream.
Welcome back to Get Rich Education. We're talking with Ridge Lending Group President and CEO Caeli Ridge. You can get started on your income property loan at ridgelendinggroup.com. So, Caeli, I think most of our listeners know that for those best loans, also known as Fannie Freddie loans or agency loans, you can get up to 10 loans. If you're single or if you're married, you can get 10 loans per spouse, 20 total per married couple. But once you've exceeded this limit, tell us about portfolio financing. What is it?
Yeah, I'm glad you brought that up, Keith. So we call it our specialty products. So beyond the Fannie Freddie, we have access to, I think, a pretty diverse menu of loan products. Typically, right after the 10 golden tickets, or 20, as you mentioned, per married couple, are exhausted, will generally roll into the 30-year fixed, same leverage as Fannie Freddie. It's actually, for all intents and purposes, almost identical in qualification and product, with the exception of the interest rate. I just actually priced one of these out this morning, so I can give an example of that. I want to say it was a purchase of a duplex, 25% down. The loan size was $150,000. The interest rate on a 30-year fixed for that was 6.375. Conventionally, that loan was posting at about 5.5. So, we're starting to see, I think, a little bit of the two are starting to line up a little bit more. I think that the secondary market, as the specialty loans are concerned, are starting to become a little bit more competitive with the conventional loan terms. So that's one of the specialty loan products. Typically, the second step after conventional. This is still one loan per property. It's not a commercial loan. It's not a cross-collateralization of debt. The other thing I should mention about specialty is you'll find almost always these will come with a prepayment penalty. Generally speaking, that'll be a 3-year prepayment penalty. But on the long-term buy and hold properties, I'm not finding that that's too much of an issue, especially when you're getting a 30-year fixed mortgage. The other product there for specialty, and this might be for those that either cannot qualify anymore under the conventional full doc guidelines, is DSR, debt service ratio. So this product is going to be probably a full percentage point over what I just quoted. Let's say instead of 6.375, the debt service ratio product will probably be somewhere about 7.375. And this loan is an asset-based underwrite. So what that means, you guys, is that we're looking at the property and the property's gross rents divided by the total monthly mortgage payment, that PITI. I'll say it again, principal, interest, taxes and insurance, and HOA if it applies. If within that division we see a 1.15 or higher, the property qualifies under the DSR. It no longer requires the underwrite of the individual's debt versus income. You still have to show your assets and liquidity and have decent credit, but that's a feasible option for those maybe self-employed that have decided that qualifying for mortgages are not as important as paying less in taxes. So that might be a nice boon for somebody out there listening that falls into that category.
So we're talking about specialty loan products now beyond your 10 or 20 if you're a married couple, agency loans. And is there any limit to the number of properties that you can go ahead and put into the specialty loan product category after 10?
We have not found that to be the case yet. No, as far as I can tell, I don't see a limit. Now, I haven't exceeded per individual specialty-wise anything more than maybe 25, so I think it might depend on how many the individual is looking to acquire past the conventional 10, but so far, no, there is no limit.
So one chief difference with these specialty loan products beyond the first 10 conventional is that a higher interest rate is being paid by the borrower. But even for those conventional spots, we have higher interest rates now than we do a year ago, probably about 0.75% of a higher interest rate for a 30-year fixed rate mortgage. What are you finding with the loans that you originate and some of the interest rates that are higher now?
Well, I'm obviously the payment difference, right? So let me go back a few months. For those that probably remember a headline somewhere in early March about the stock market taking a substantial nosedive, that was the day of the catalyst that we saw probably the single biggest long-term interest rate jump that we'd seen in over 4 years. That coupled with a Fed fund rate increase between then and now have exactly what, Keith, you say, increased interest rates between 0.75 and a full percentage point from where they had been for quite a while.
Yeah.
The properties are still cash flowing very nicely. You know, if you were, as an example, this might be helpful. Let's take a $100,000 loan amount, and let's say that the difference between they're exactly identical. One was purchased pre-March of 2018, and one's being purchased right now. So let's say the interest rate pre is 4.75. And let's say the interest rate right now is 5.75.
Okay, so 1% interest rate difference.
Yes. On a $100,000 loan, that mortgage payment difference, or that principal and interest payment difference, is $49 a month. So if you were cash flowing at $300 prior, now you're going to be closer to $250. But the things that I'm trying to remind my clients where this is concerned, well, there's a few things. There's some tax implication that gets a little complicated, that if they think that they're losing $50 a month or roughly $600 a year, it may not actually be that much when we start throwing in some of the tax pieces. That's really individually discussed. But then also remember, guys, that the interest rates and the rental rates, they're very closely tied together. You should be appreciating your rents on an annual basis, a minimum of 2%, and depending on the market, sometimes 3, 4, and 5%. Make sure that your property management, your ideals are aligned there, because the rents will catch up with the increase in interest rates.
So higher mortgage interest rates, obviously decreasing your cash flow, but probably not as much as you thought. So, Caeli, you see so many loan packages come through there, and you also see appraisals come in for properties during that loan process. What percent of appraisals do you see come in low? What percent of appraisals do you see come in right on the contract purchase price? And what percent of appraisals do you see come in higher than the purchase price?
Ooh, that's a good question. I'm going to say 15% probably come in low. I'm going to say 5% come in high, and we'll leave the other 80% as right on the money. Let me add a detail there. So because we're so focused on investors and their needs, and we know that the appraisal piece is that one variable. By definition, the appraisal is an opinion of value. So that one variable that can make or break a deal sometimes. I know other colleagues in the industry where the appraisal can be problematic. I mean, if you get a low appraisal, it blows up the whole deal more often than not, I guess, depending on how low. But one of the things that we get to apply, because we are so investor friendly, for those that are not aware, all appraisals ordered for residential properties are ordered through an AMC. This stands for Appraisal Management Company. Now, we have a self-managed AMC, which means that in the specific markets that we do large volume of non-owner occupied transactions, we have put together a preferred panel, which means that we have selected from a big pool of appraisers that understand the non-owner occupied side of properties that are within a predefined diameter or radius of living in an area of where we're asking the appraisal to be performed. These are all important things. Non-owner occupied loans, we've already established, is a very unique animal. So if you think about it from that perspective, the appraisers out there too, majority of what they're doing, 90-95%, is going to be for owner occupied. So making sure that we're pulling from, as a random selection, appraisers that do understand this side of appraisal and lending is really important. And we've been able to select and create these preferred panels in the different markets. So we don't find the short values as much of a problem, I think, as maybe other lenders might.
So we're talking about real estate appraisals. That is basically an independent third party verifying the quality of the bank's collateral, which is your property that you've gotten a loan on. Yeah, that's very interesting. In these appreciating environments with all the applications that you see come in, about 15% of appraisals coming in too low, 80% coming in right on the contract purchase price, and then 5% coming in higher than the contract purchase price. So, Caeli, 12 years ago or so, we had lending practices that were super loose. We had what they called ninja loans, NINJA, which stands for no income, no job, no assets. Where do you think underwriting guidelines are today? It seems to me like we're kind of in a sweet spot. They're away from when they were too loose and irresponsible, and they're also away from that opposite restrictive end. What are your thoughts, just generally?
Yeah, I think that that's a good point. As irresponsible, I think, as the knee-jerk reaction to what was going on before, I feel like we've kind of come out of the dark ages. Certainly the loans that were being secured post the crash of 08-09 were outrageously dangerous, and we know what the result of that was. But like I just said, the result of that, I think, was equally as irresponsible, and how tight the guidelines were for many years right afterwards.
Yeah.
I feel like, there's a level of normalcy now. Yeah, I think the sweet spot is a great way to describe it. I think we're in a really good place, in addition to which we actually have alternative means with those specialty type loans that we can access now where we didn't before. So, yeah, I'm excited about how this is going to continue to unfold and keep within responsible range, but still allowing some additional flexibility for the consumer.
Well, Caeli, are there any common obstacles that a borrower can eliminate or can tailor their financial lives for now in case they want to qualify with you a few months down the road? What can they do?
I would just say being organized with your documentation is probably going to be their biggest hurdle. I make a joke about this. It's my one mortgage industry joke, but it's effective because it paints a picture. In addition to gathering all of your supporting documentation, I always say make sure you have a few vials of blood and DNA samples on hand for us. It breaks the ice a little bit, but that's sort of the expectation anymore. So above all else, I would say just being organized with your bank statements, your pay stubs, your tax returns, your lease agreements for those that already own properties, tax statements, all of that stuff, having it handy in one centralized place is really going to create a lot less brain damage on your end and make things much easier on your lender.
So borrowers, get ready. There is still a good bit of documentation that you're going to need to prepare. That's just part of the fairly responsible lending place that we're in today. Well, Caeli, there at Ridge Lending Group, I know that you do loans in 41 of the 50 U.S. states. And importantly, that includes pretty much what I call all of the investor advantage markets in the Midwest and South. And we're talking about you, the borrower, as to the state that your property is located in, not where you reside as a borrower. Caeli, what's the best way for a borrower to get started at Ridge?
They can call us toll free. 855-74-RIDGE is an easy way to remember, or 855-747-4343. Or they can find us online, www.ridgelendinggroup.com, or if they'd like to send an email, info@ridgelendinggroup.com.
Caeli Ridge, you're a wealth of income property lending information. Thanks so much for coming back on to Get Rich Education.
My pleasure, Keith. Thank you.
So for a 30-year loan, you're still seeing interest rates under 5%. Caeli mentioned about 5.5% for an income property today. And then beyond those 10 loans for a single person or 20 for married, which is what they call their specialty loan product, once you've gone beyond those thresholds, it's still a surprisingly competitive 6.375%. And they still haven't found a limit to the number of 1 to 4 unit properties that you can grab with those specialty loan products. Now, what about Helocs, home equity lines of credit? We know you can get them as a second mortgage on your primary residence a lot of times, but can you get them on investment property? Well, they're still pretty difficult to find. 2 banks that Caeli knows about that offer them are pretty restrictive on this. You can't own more than 4 properties, and there's a maximum combined loan-to-value ratio of 65%. Again, that's for if you want to crack a Heloc second off of an income property, and very, very few banks offer that. Now, just for comparison, back in 2005, when money was flowing freely, and I think a bit irresponsibly freely, I think I shared with you previously that I got a 90% loan-to-value loan on a non-owner-occupied fourplex that I had at the time. That was beautiful. That's not going to happen today. We've talked on the show before here about how your monthly Heloc payment affects your debt-to-income ratio. And be aware of something. With the new tax law, Heloc interest is not always tax deductible. Rich Dad Advisor Garrett Sutton first informed me of that. Check with your CPA for details. Remember, Tom Wheelwright says, put taxes into perspective. Don't let the tax tail wag the dog. It is just one of many considerations. And here's a really important thing for you to keep in mind. Fewer people are going to be itemizing their taxes at all. So tax deductibility of everything is going to matter to fewer people in the United States. That is because the new tax law means that if you're single, the standard deduction has risen from $6,350 last year up to $12,000 this year. So that's nearly doubled. And for couples, the standard deduction rose from $12,700 last year up to $24,000 this year, again, nearly doubling. And that's pretty monumental that the standard deduction has basically doubled from last year to this year, because previously, year over year, the amounts just kind of nudged up slightly with inflation. So that means that if you have fewer deductions than those thresholds I just talked about, it won't help you. You'll just float up to the standard deduction threshold, because that standard deduction amount is what you can deduct from your income, and the result of that will be what you pay your income tax on. So when you've connected with a provider at greturnkey.com and you've chosen your market there, before you get too far down the road with property selection within that chosen market, you'll want to submit your loan application at ridgelendinggroup.com. Yes, you will be asked to submit a lot of documents, and it can inflict a little brain damage on you there. Of course, I'm an active buyer of 1 to 4 unit income property myself, so I am quite used to providing lenders with my last 2 years' tax returns, last 2 months' bank statements, mortgage statements. I'm also in some partnerships, so I have something called K1s that I need to submit. I don't have a day job, so if you do, on top of that, you'll have to submit W-2s and retirement account statements and more. So, my tip there is just be organized, and it will not wear you out so much. Often, it always seems like there's some little oddball thing that you need to scrape up as well. When I qualified for my last property, what I was doing was transferring money from a business account over to an account to fund the purchase, and I needed a letter from my CPA to say that pulling money out of a business account to fund the purchase was not going to threaten my business. So there is a little work putting your loan package together. There's no doubt about it. But, that's part of why we're still in a responsible lending environment. It helps mean that people that are buying the properties can actually afford the properties, and that makes a price collapse less likely. And to you, it is almost certainly worth doing for the leverage. Well, Caeli Ridge has generously given her time to you on this show more than any mortgage loan company person ever has. So when you get started over there at ridgelendinggroup.com, tell them thanks. Until next week, when I'll be back to help you build your wealth, I appreciate your listenership so very much. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
Ranked by Forbes as one of the fastest growing cities, Orlando, Florida has a big and diverse economy, yet still features affordable rental properties that cash flow. Our boots on the ground turnkey provider, Greg Bond, wrote a special report to help you discover the amazing market of Orlando. Request your free copy today. Visit GetRichEducation.com/Orlando. That's GetRichEducation.com/Orlando.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.